All right. Yeah, so this week we're back with John Trama again. We're going to be talking a little bit more, try to keep you guys tuned in at least on a bi-weekly basis of what's going on in the market here on Long Island, across the United States, and talk to you about some financial options that John would have for you. So market-wise, the market I feel like has has stalled all of a sudden in the past week or two, and it's not that we didn't expect it, but it seems like it's little more abrupt than what we expected. We expected a slowdown, and now it seems like some listings aren't even getting some showings. There's more homes coming on the market, um, and there's more price. I'm noticing more price reductions all the way across the board, all the way through Long Island. Um, what do you?
Price reductions are always good, right?
Yeah, price reductions are good. Interest rates are up, so it's got to adjust some people that have been sitting on the market for a little while.
Right.
You know, and they're going to have to bring their price down to compensate for the higher interest rate. It did go down what, a quarter last week?
It's funny. It's this market's driving me to drink, man. I mean, honestly, I've lost all the hair that I had, since I started in this industry. But yeah,
Right.
it's been an absolute roller coaster. We've seen some significant changes, obviously in the last 4 months, and most recent, I would say the last 3 weeks, we've been trending in a more favorable light. Where to your point, yeah, we've reduced about a quarter to 3/8%, and some banks were actually just a smidge under 5%, which we haven't seen in quite some time. And
Okay.
oddly enough, man, the last couple of days we've seen a complete market correction, and whatever gains we had received over the last 3 weeks are now lost. And so
Okay.
it's really frustrating from a bank's perspective, but also I know for buyers as well. So that kind of leads me into what I wanted to discuss today with you is considering long-term rate locks.
Okay.
Now, when a buyer is looking to lock in, usually there's a designated amount of time that we would lock in, and we're always looking at the contracts and what the on or about time is, and making sure we lock accordingly to that specific date. But somebody who's a potential buyer today that doesn't have a house yet,
Hmm.
what can we do to protect them in a volatile market such as where we are today? And we have extended rate lock opportunities where we can actually secure a rate lock up to 360 days. So
Wow.
yeah, so it's pretty unique. I mean, some banks offer it, not all. But
Okay.
the idea behind it would be to kind of minimize some of the potential risk of what we're seeing in today's market.
Right. Right. Typically, when you talk about a rate lock, it's like what, 60, 90 days?
60
No,
days
and
is
then,
Yeah, 60 days is typically the norm. Obviously, the way it works in our market is that the shorter rate lock period, the
hmm.
better your pricing is. So 60 days usually we can lock in without any real costs. Once you go beyond 60 days, typically there are costs associated to it. And again, we can go up to 360 days. So I'll give you an example. So let's say, you're definitely you're interested in buying a house. We don't have anything lined up yet. So let's say we want to lock in something for 180 days. We'll give you a 6 month, rate lock period. And so what we'll do is we'll charge you like a half a point. A half a
Okay.
point, like let's say you're going to borrow $400,000. A half a point is $2,000. So we collect $2,000. We lock you in for 6 months. If today's rate is 5%, we're going to lock you in at around 5.25%. We'll say. Okay. So now you're protected. Now, in the event that nothing changes and you close, you find a house, you close, we will refund you that half a point at closing. But you're protected against the rates rising anything above that 5.25. Now, let's say in a perfect world, let's say you locked in at the 5.25, you're hedging, and let's say the market does improve, and let's say the going rate is say 4.875, maybe 30 to 45 days
Right.
before you're ready to close, we will actually exercise what they call a float down or rate renegotiation and give you the current market rate. So
Oh,
you're
nice.
yeah, so
Yeah.
it's a win-win. So you're minimizing your risk by locking into something today. Yes, so there's a slight increase in rate, but it's a niche product, so you are going to get a little bit of an increase for that. But the upside is that if the rates do go up, you're protected, and if they do go down, you get the benefit of that too. So to me, it's a
Yeah.
win.
Now, I feel like that could work. I feel like all the sellers that are on the fence, there's no inventory. I don't know where I want to move, etc. I feel like by listing now, they would, and having something like that, they would get a higher value for their home, because as the season goes on, the market starts to stabilize, or it has been stabilizing. Um, they're going to get the right value for their home, but then they're not going to worry so much about paying a higher interest rate down the road.
Yeah, absolutely. That can work for a seller looking to relocate too. Absolutely, 100%.
Yeah. Okay.
Yeah.
Yeah. Very good.
Yeah.
Yeah. I mean, what else? What other options do you have?
Yeah. So aside from long-term rate locks, we're definitely pushing adjustable rate mortgages today.
Okay.
It seems that that's working for some. They say that the average first-time home buyer is between 5 and 7 years that they'll stay in their house. So if you're wanting to offset some of the recent gains in interest rates, you could possibly explore the adjustable rate, which would be a more favorable rate, bringing you probably into the 4s or maybe even the 3s, depending on the type of loan and your qualifications. But the idea would be that the rate would be fixed for a set amount of time. Could be 5 years, could be 7 years. That's typically where you would see the benefit. There is a 10-year arm, but that doesn't really price out that well. So a 5 and 7 year arm where it's fixed for that specific amount of time, and then it would be subject to adjustment. But typically we could forecast where that rate's going to be before it adjusts. We can make decisions. We could refinance. So you have opportunities and options. But also too, you could possibly sell your house at that point.
Right. So, right. And then you're out of the loan altogether.
So you
paid a lower, you ended up, now can you do both? Can you set up a package where a seller who's not sure where they're going to go can do a rate lock on an adjustable?
Yeah.
On that?
Yeah, adjustable or fixed, doesn't matter.
Okay.
Absolutely.
Okay. So now they can go into, like, say somebody is not going to, they know they're going to move again in 7 years. They're just staying here for, maybe their kids are still in college, but they want to upgrade or downsize. That's a great option for them also.
Yeah. And again, I think that's one of the advantages of working with certain loan officers. Look, I don't consider myself an order taker, right? So when people call me and they go, "What's your 30-year fix?" Well, that's fine, but have you thought about this? And it's just about creating options. And if you're not getting options and you're in the marketplace, make sure you're getting them. And if you're not, feel free to reach out to myself or at least another lender, because there are other opportunities out there. And it's our job as loan officers to educate you. Okay.
Yeah, definitely.
And I would say the last thing that we're doing to help kind of offset some of the rate increases is paying points, right? Points were something that was pretty prevalent back in the day. Then we moved away from points. People, didn't want to pay them. But it's a great way to offset some of the interest rate hikes and a way for you to get a lower interest rate as a result. So some of the things that we may look at to do is maybe put a little bit less money down, use some of that money to restructure your loan in a different way. Maybe using some of that money that we were going to put initially down to apply towards paying points and reducing your interest rate, where you'll spend less interest over the life of the loan. So again, there's a lot of different things that you can do to still keep your financing attractive in a rising rate environment.
Right. And competitive also when you're making offers.
Yeah, definitely.
Yeah. And I like what we talked about last week of having the loan commitment already set in place
prior
to making the offer, because that's almost like saying you have cash in hand.
Yes.
Wow.
Yeah, that makes everybody's job a lot easier. That's for sure.
Okay. Very cool. Yeah, I just want to talk, numbers in Smithtown and Comac. I noticed the inventory has gone up a little bit. Prices are kind of still the same, but I have noticed more price reductions, and days on market are starting to draw out, so the days on market are no longer the homes aren't just selling like that.
Like they were.
Buyers, I believe, have put the brakes on, And now they're like, okay, we want to see our options because we know the market's going to start to, settle.
Yeah, and again, for anybody that didn't watch our last week's video, again, it's you can't time the market. It's time in the market, and I will say that until I'm blue in the face, because that is the honest truth. And I never thought that my house would be worth what it is today after what I thought I overpaid when I bought it back in 2008. So you just never know. So you can't sit on your hands and wait, because the longer you continue to wait, the opportunity is going to be lost.
Right. Especially if you're renting or whatever, you're just sitting on you're waiting for an opportunity to happen that you should be taking action on right now.
It's true. 100%.
Yeah. All right. We will see each other next week or possibly the week after, depending upon our schedules. We're going to try to do this every single week.
All right. Sounds good, Jim. Good seeing you.
All right.
All right. Take it easy.